obviously we're watching the market give way each day, and we're looking at the bigger factors out there. And it does appear to us, yeah, that we could be in for a bit of a retrenchment in the markets just based upon fundamentals. I mean, you've got increasing energy costs. That's going to cause increasing inflation. You've got further decoupling going on in the global economy as a result of the war in Iran. I've got interest rates actually going up quite a bit, and that's going to have to filter through the economy, and that's going to have a very strong negative effect on the overall economy, given the indebtedness of the economy.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Today, we have the good fortune of being joined by Jonathan Wellum, who is the founder and CEO of Rocklinc Investment Partners, which happens to be Thoughtful Money's endorsed financial advisory firm up in Canada. Jonathan, thanks so much for joining us today.
Great to be with you, Adam. You've picked a great time for me to talk with you, given what's going on in the markets here.
Yeah, it's not like there's a shortage of things to talk about. I also want to thank you. When this video, we're recording it the day before Thoughtful Money's spring online conference, but it's going to run the day after, and you're going to be an important part of that conference. So I'm thanking you in advance while we're recording, but retroactively after this launches, for your involvement there. It is going to be, I know at this point in time, I'll feel comfortable saying it was a phenomenal event. And just want to remind folks, if you didn't watch it, but you wish you had, don't worry, you can still purchase a replay of the conference, folks. Just go to thoughtfulmoney.com/conference and you can purchase the replays there. All right, Jonathan, like you said, a lot going on in the world. And I kind of want to make that part of the thread we talk about here, which is, I think about that Rudyard Kipling poem, If. I should have pulled it up here. I don't have it in front of me, but it's like, if you can keep your head while all those around you are losing yours. I think this is one of those times in the market, or it feels like it's about to be one of those times, where there's so much concern swirling around here for very understandable reasons, whether it's what's going on in Iraq, whether it's what's going on in private credit, whether it's people just watching their portfolios start to shrink here. If they've been, natural resource holders, especially in the precious metals, they're watching those get kind of clobbered right now. I think the only people who are doing well are those who own oil and gas stocks at the moment. But how do you help people kind of just keep perspective and keep from being their own worst enemies at this time? Because we know that most investment decisions that are made out of emotion tend to be the wrong decision at the wrong time.
Yeah, great question. And that's really what, as advisors, that's how we really earn our keep. I'm talking to our guys in the office today, and I said, this is when we actually really have to work hard and to keep the long-term focus. So we go back to why we are invested in the various areas that we're invested, why we own some of the businesses that we own, why, for example, are we in precious metals? And has the thesis changed at all? Just because there's some circumstances that are, causing a disruption in the markets right now. And so we always go back to looking again out 2, 3, 4 years where we want to be and look at the underlying reasons for investing in these sectors and in the particular businesses in the first place. We have to stay focused. I've been doing this for 36 years, almost 37 now, believe it or not. And I've seen tremendous volatility, back in 2008. I remember I should say, 2008, there was a financial crisis, but even to go back to 1998, long-term capital management, we had a lot of financials. And they, Merrill Lynch, I think, went from like $80 to 25. And you got to look through the long term. Of course, the Nasdaq peaking out in 2000 and so forth. So the issue is, when you're investing, why are you investing? What's the thesis? Is it still intact? Can I take advantage of the volatility to dollar cost average and actually increase my positions? And for goodness sakes, don't be buying high and selling low. That's what is really condemns a lot of retail investors who aren't focused. So that's what we do. We just go back to our basic thesis, look at the valuations, and just stay focused.
Okay. One of the things that I think a lot of retail investors are guilty of, and folks, I've been guilty of this too many times myself, is we tend to get an insight, right? Whether it's we've actually done our homework on a specific company, or we are reading and we think we identify a macro trend and think, okay, this company is going to benefit from that, right? So we're pretty good at coming up with like a rationale for buying a security. We're not great at the same time in our mind determining, okay, well, under what conditions are we going to sell, right? Our just general hope is, okay, I'm going to buy this thing. Hopefully my thesis is right. It's going to make me a lot of money. And then at some point in the future, I'll have more money. you know, yeah, maybe I'll sell it, but we don't really, there's not a framework or a formula that we're putting together to say, okay, if it hits X within Y zero amount of time, or if this change happens macro, that's going to be my trigger. We just kind of think, well, in the future, I'll figure out when to sell it, right? And then we get into a point like this where there's just a lot of uncertainty there, and we look at our portfolio, and we all of a sudden realize, yeah, I'm not really sure why I own half the things I have in here. Right? I felt passionate at the time I bought it, but like I'm not sure how I feel about it now, and I don't know whether it's worth keeping in the portfolio or not. So this kind of goes back to the old, know what you own um, maxim in investing, and this is one of the reasons why I recommend people work with financial advisory firms like yours, is because you guys don't have the luxury of just buying and crossing your fingers. Your every decision you make you have to justify to everybody else at the firm and your clients why you're buying it. And then you kind of have to justify it on a daily basis why you continue to hold it. So you know why you're holding it or why it's time to get rid of it. How do you help the average person there who is just looking across their portfolio and seeing a whole bunch of names where they're just like, I don't know if I want to be holding this going into further uncertainty, but I don't know if it's a bad time to sell or not.
Yeah, I mean, part of that is upfront education. So making sure that when clients come in, they understand that there will be volatility. We tell clients, so look, if you're not prepared for a 30-40% drawdown on some equities, I mean, not that we want to go down that much, of course, but whenever you buy something, you can get a drawdown like that if you don't have a stop loss in place and so on. And so we try to prepare clients for some inherent volatility that will emerge. You also, when creating a portfolio, make sure that you have some assets that aren't overly volatile so that if they need money in the short run, they can take from that part of the basket, if you will. And so asset allocation is very important. Along with that, if you do have a sector like precious metals that has run quite a bit, like very quickly, that's a sector you want to take some money off. So take a little bit of money, take some profits, reallocate it. That's a discipline that's very important also. And then a sell discipline as as you basically are laying out there. If if the thesis change gets overvalued, better opportunity, you sell the security. The security doesn't care if you own it or not. It doesn't have, there's no love relationship between you and a stock. And so you got to be able to part with it when it doesn't make sense. And so again, all of those factors come into managing a portfolio, managing expectations, and managing the risk in the portfolio.
All right. I mentioned some big concerns that are swirling out there in the headlines right now. I'll get your opinion on them in just a second. But there's one development that I'm curious how concerned you are about it, which is if you look at technical analysis, one of the factors that people look at a lot is daily moving averages, and they have started to cross over to the downside. And pretty much as of the day we're recording here, Jonathan, we've punched down below the 200 daily moving average. It's looking like we're probably likely going to close there. TBD was going to happen next, but a number of the folks I talked to sort of they see that as a critical support level. And so the question is, we'll find out. We don't know for sure at this time, but we could potentially be on the precipice of a fairly large coming down leg in the markets because we've punctured that long-term support. How concerned are you about the fact that we are now below it?
Yeah, I mean, to be honest with you, we don't spend a lot of time on technical analysis. We're bottoms up, value oriented investors. I mean, clearly we also look at some of the macroeconomic trends. So that's not something that we're preoccupied with. Having said that, obviously we're watching the market give away each day, and we're looking at the bigger factors out there. And it does appear to us, yeah, that we could be in for a bit of a retrenchment in the markets just based upon fundamentals. I mean, you've got increasing energy costs. That's going to cause increasing inflation. You've got further decoupling going on in the global economy as a result of the war in Iran. I've got interest rates actually going up quite a bit, and that's going to have to filter through the economy, and that's going to have a very strong negative effect on the overall economy, given the indebtedness of the economy. You've got just so many geopolitical factors going on and uncertainties right now in terms of the Strait of Hormuz. There's so much important economic commerce goes through that. Not just the 20% oil, but you've got fertilizers. You've got the issues with natural gas now that have been interfered with, the LNG facilities in the Middle East. So, I mean, there's just a number of things that I think are weighing on a global economy. It's already really leveraged and didn't really have a lot of growth anyway. Outside of the United States, I mean, there's not a lot of economic growth in Europe. There's very little in my own country, in Canada. And so when you look around the world, if you put these kind of headwinds in the system, the increasing interest rates, the increasing energy costs, which are going to filter through, and increasing inflation, and so on. I think to see a global recession can all of a sudden becomes quite probable. I mean, I'm not calling for that, but these things are going to be big concerns. You mentioned private equity, private credit. We're seeing all sorts of issues bubbling up to the surface there. In my own country, in Canada, we just did a quick report in the private real estate market in Canada. So about $80 billion has been raised over the last number of years. So multiply that by 10 if it's in the U.S. economy. We're about 1/10 sort of the U.S. So 80 billion was raised, and these are private real estate equity funds, and 40% of them are gated. 40% of that are gated.
Wow.
And so again, you're seeing this pressure coming, and people don't talk about it that much. You're seeing some of that in the United States, some of the gating that's going on, but the gating is there because again, they don't have the liquidity. People want out. They want out for a whole host of reasons. Quite a few of the funds that have been gated have cut their distributions. And a lot of people bought these strictly for the distributions and maybe a little capital upside. And what comes next, Adam? Probably write-downs, right? And so, so there's all of this swirling around, I think, that is concerning, and I think is going to put a lot of downward pressure on economic growth, not just, of course, in the United States, but around the world. And so I think that's why the market's really, really getting heavy. It's tough going. We've had a lot of excess. You've talked about this, the lag effect. Maybe we're finally getting it in the market. And so I think people need to tighten their seatbelt and get ready for some volatility, increased volatility, and maybe some downside for a while.
Okay. And what's interesting is there's a lot of angst around this right now. But the markets are down, what? A little over 400 points from their all-time highs. I mean, it's not a lot, and there's a lot of room. There's a lot further to fall, right? So if people are freaking out now, I wonder if there is another down leg like we're talking about, what the fear factor is going to be, on Wall Street at that point in time.
Yeah, I mean, if you look at the TSX in Toronto, we're now just negative for the year and probably off about 4 or 5% from the high. And as you know, in the U.S. market, the Nasdaq might be down 5-6% year to date or so, and the Dow is just a little bit less than that. So yeah, we're not very far off the highs, and people are very concerned. But I think that's just because of the overall environment in the world, the unsettledness that's going on. There's just so much activity. Every time you turn around, there's things taking place, and I think it's just sort of throwing people off. And it's unsettling. People are just not settled, I think, in terms of their stations. Yeah.
Well, so at the conference, the keynote was provided by Lacey Hunt, and he, as he usually does, he does a graduate level walkthrough of a whole bunch of charts about our current situation. And this conference, it was all about studying how oil shocks have impacted economies in the past. And, in particular, when an oil shock happens, when the economy is already somewhat compromised. And, the short answer, folks, is nothing good, right? And so, Jonathan, we could have, and we were talking about a number of the concerns that you and I have rattled off here so far before the war was enacted against Iran. And not only does the war itself put an uncertainty premium on markets, but obviously what's been going on with oil prices is the real big concern. It's sort of like, hey, we had an issue, or we had a environment that we were quite worried about beforehand, and now we have this exogenous shock that is quite bad. There's no real good way to spin it. How much more vulnerable is that going to make the fragile system that we had before? And of course, the big answer to that is sort of twofold. It's, well, how long does this war last, right?
Right.
And then secondly, how much damage is done to the Gulf energy infrastructure? And that's
Exactly.
been, I think, the very concerning development this week is that both sides have started hitting, um, oil and gas installments that will take, honestly, months at best to get working again. And in a number of cases, they're saying years, right? And of course, that's what's been done so far. Who knows how much is going to be done going forward? So there's this big uncertainty factor out there still of just how much more could this be, right? How much more damage could it be? How much longer could the war last and these high oil prices sustain? So, you try to sort of see all the different permutations of what could happen and come up with a probability distribution, but it's hard to find many parts of the tail that don't have some sort of quite negative lingering effect from what's going on right now with this war.
Absolutely. I mean, look, we've been facing, the end of a debt cycle. I mean, we were in a huge debt cycle. We've got an issue with currencies, our whole currency system. You've got this major political struggle going on now in the Middle East and all of the implications of that. You now got a jacking up of energy costs at a very vulnerable time in the global economy. And as you point out, it doesn't appear that those energy costs are going to come down that dramatically soon, simply because there's been some damage and the world can absorb some of this, but if you've got the LNG facility in Qatar has been hit, that they're talking maybe a couple of years for parts of that to get back up, and so the energy assets in Iran are compromised. Other parts of the world. I mean, you take a couple million barrels of oil off the market, and it can have a profound effect. But that runs through, as you know, every part of the economy. Every part of the economy now is going to be increasingly stressed. Also, at the same time where you're having this, bipolar world being developed, right? So at the same time that we're kind of getting east and west, in my view, we see, that sort of, building now, that sort of China, United States, and the sort of the standoff there. That means, again, all of these goods that are coming from the east to the west, probably less. That means increasing prices, probably, things like that. So there's so many things going on that I think can feed into inflation or stagflation environment and that are upsetting for people. And we just don't know how this is all going to pan out. I don't know how it's all going to pan out. That's why when we come back to our investment thesis, we stay pretty focused on some of the precious metals. We stay focused on businesses that we think, can absorb this pressure and continue to do well and so on. And also are trading at, attractive prices so that we're not overpaying. But no, it's a world that's facing a lot of challenges and they're all coming to a head. And then you throw this mess of increasing energy costs into the middle of it all. And yeah, it's one that's I think investors have a reason to be concerned and to be focused on what they're investing in and be watching their capital.
Mhm. So obviously, this was a big topic of conversation at yesterday's conference, and I'm saying yesterday, even though we're recording it the day before. But I've seen all the presentations, and you know, when you get a whole bunch of people together, you're going to have differences of opinions, right? That's what makes a market. But I will say, Luke Roman um, is very concerned about all this, and made the comment that he is concerned about an outcome that, in his words, could be worse than COVID plus 2008 combined, which is a pretty big statement. And I'm not trying to freak everybody out. And I'm not saying you have to share that as well, Jonathan, but I'm just mentioning it to say, hey, some of these smart people are really concerned about what these knock-on effects could be. Um, Let me ask you a question, maybe to the positive upside here, at least for part of the world. I asked Lance Roberts this in yesterday's weekly market recap, but I'm curious to hear your thoughts too, especially because you're from Canada. Um, I think even if the war ends tomorrow, but especially if it lasts for a lot longer and gets worse, is um, I think the risk premium to purchase oil and gas through the Persian Gulf is going to be substantially higher in the future than it has been up until this war. Um, it's going to be more expensive to insure ships. Countries are going to be, once bitten, twice shy. I'm not really sure I want to do this in case my tanker gets marooned inside the Gulf if they close the strait again, or God forbid gets hit by a missile or whatever, right? If Iran decides to, if the regime is still intact and it starts to try to, enact a toll of any ship going in and out of there, which apparently it's maybe starting to do now. So we've all heard the stat that 20% of the world's oil, flows through the Persian Gulf, as of right before the war. I'm one man's opinion, but I'm going to guess that percentage of the world's oil that the Gulf represents is going to go down, or at least as a ship through the Gulf is going to go down for two reasons. One, I think, and apparently we're already starting to see this. You've got countries saying, you know what, I think I want to start buying a larger percentage of my oil from quote unquote safer, friendlier parts of the world, right? It might be Canadian oil, it might be US oil, wherever. And so I think our countries could potentially be net beneficiaries of that. And I understand that some people watching this might not like that. Maybe it looks like war profiteering or whatever. But I think that could be one of the outcomes of here. I also think, and we've heard talk of this too recently, a lot of the countries that are on the coastline there in the Gulf will be working even harder, and a number of them have already built infrastructure to do this, is to provide alternative ways to get the oil and gas out of their country and getting it onto a ship without having to traverse the Gulf, right? So these are pipelines that are going, to the Red Sea or to other potential distribution points. So my point here is I think no matter what happens, the Gulf's output's probably going to be a bit diminished. It's going to be more expensive. And other parts of the world will probably benefit. And of course, other parts of the world too it's a reflexive system. They'll say, hey, look, the world wants to buy a lot of oil, but not from the Gulf. Well, we'll increase our production here and we'll sell to them. So do you see this? Because I know you're very resource oriented in your, the types of companies that you invest in.
Yeah, no question. I think we're going to see dramatic changes take place. An event like this really sharpens people up. I mean, it's also coming at the same time, Adam, as you know, where we're getting this sort of deglobalization, right? In other words,
Right.
I think Trump has really been pushing this, that we're, too dependent on China, too dependent on an enemy or someone that's not exactly your best friend, someone you can't trust, and becoming much more independent in terms of all of your resources from a Western Hemisphere perspective. So I think it's going to play right into that very, very well. And you're already seeing that. I mean, you had some of the government officials over in Japan cutting deals on energy and so forth, so that they can bypass some of the Middle East and the Persian.
Yeah, just to that point, it wasn't just Japan, but we just struck a deal the U.S. did for 56 billion for a number of Indo-Pacific countries, including Japan. So I think that if you listen to the administration and trust them, they're saying basically the phones are ringing off the hook right now.
Yeah, and I'm up in Canada. I'm just salivating at that of what you guys are doing, because in Canada we've got so many resources, but we have the incompetence and lack of initiative on the part of our federal government in particular, but also some of our provincial governments to develop these resources. So I mean, we should be getting much more LNG out of our country. We're doing some small deals. But a few years ago, the Europeans came to us, the Japanese came to us, came to our Prime Minister Trudeau at the time, and he said there was no business case, if you can believe it, no business case. And so, but I think that's going to change. There's going to be so much pressure, and hopefully the current leadership in Canada or new leadership will recognize that ability, because Canada, especially for the US, we should be developing stronger relationship with each other, because we have all of the resources. Anything you don't have, we do have, and we're right next door. And it's much safer, of course, and it's all within the hemisphere. So uranium, potash, of course, natural gas, the years of development we have in our oil and gas sector is much larger than the United States, and so on. Lumber, aluminum, because our energy costs, because of hydroelectricity in Quebec and some of our provinces, is just so low. It's a fraction of the cost that you're going to have in the U.S. But we can smelter the aluminum as I say, at a fraction of the cost. These are things that we need to start thinking about and developing. But of course, you need the intellectual horsepower and people to want to do that, right? But no, I think it's going to change. It's going to change quite a bit in the world. Having said that, with all of these changes, as you know, Adam, that changes the world, and it causes increase in prices and dislocations for a period of time. And I think that's what the market's worried about, that we could, again, it's fine to say we're going to change our distribution model, but we're used to a pretty efficient one right now That's being interrupted. Now we're going to have to replace it with something else. That means increased costs, increased infrastructure costs, and just all of those changes that will have to take place. And I think, again, that's why the market is looking at this and going, oh, no, this could be inflationary for a little while. And without a lot of economic growth, that could be stagflation. And we might not get, we might not advance very far. And this could be a serious problem. And then with all the debt, how do we pay for the debt? The interest rates go up, as you know, every 1% increase in the interest rates in the U.S. is another 390 billion in interest costs. Who pays for that? So, I mean, again, you go back to Luke Groman's comments. I'm sympathetic to what a lot of what he's saying, simply because the numbers do not add up. You can't have a $39 trillion debt, unfunded liabilities, a budget bringing in a little over 5 trillion, spending 7 trillion. You got a war that's going to cost, they say, a couple $100 billion, but I think the last time they said the Iraq war was going to be what someone said, half a trillion, half a trillion or so, 500 billion, turned out to be $3 to $4 trillion. Where does all that money come from, right? So again, when you add all that up, you're sitting there thinking, yeah, you're going to be concerned. You're going to be trying to protect your capital. There's no question. There's a lot of uncertainties.
Okay. I want to ask you in just a second about, the potential, well, given this outlook, what an investor should be thinking, but also how they can position themselves for sort of the period after, where hopefully once most of the change and volatility and pain of the system is bled through, sun's going to come out again, and there may be some really good opportunities to own some great companies at good valuations. Real quick though, let me just ask, because you have the Canadian perspective, and I'm not asking you to speak for all your countrymen or even speak for yourself individually, but what is the tenor of what America is doing in Iran right now? Is it, hey, this is the right thing that needs to be done, and it's unfortunate, but I hope they succeed? Or is it, what are these crazy cowboys just gotten the world into?
I mean, my view, I'm as you know, more sympathetic to what the U.S. is doing. Again, I don't know all the ins and outs and the information that the Trump administration has to pull the trigger on Iran, but it's been a very bad, global player and a real problem for the Middle East and uncertainty. I think overall in Canada, it's a little more of a liberal. It's a bit more, in your terms, democratic, if you will, versus Republican. And I think I'm fairly accurate in saying probably the majority of Canadians would not be overly supportive of the U.S. going into Iran, but there'd be a good sized constituents that certainly would support it. So I think it would probably be somewhat of a split. We've got a large Iranian population in Canada that is overjoyed with it, of course, and want to see a change in terms of the government there, because of the revolutionary government there has just been absolute butchers. I mean, these are just awful, wicked people. So, but I think overall, to answer your question, it would be a mix. It wouldn't be overwhelmingly in support, and there'd be certainly a lot of people that wouldn't like it. And some of that I think is fed by Trump derangement syndrome. Him poking
Sure.
around.
And Trump earned the ire of the Canadians. I mean, there's no.
and there's a bit of that going on, unfortunately. There's nothing I can do about that. I try to encourage the relationship. I think the United States is our most important trading partner and most important country that we need to be friends with, and we should continue to work on that front. In fact, our leader of our opposition, Pierre Poilievre, was just down in the United States recently. Just did the Joe Rogan show, and again, is just trying to get that more conservative message that sometimes doesn't get out about Canadians. That we are sane, sensible people in many regards, and we do want to work with the United States. A lot of us do, and we've got a lot of great resources. So let's get a deal and continue to work to both of our advantages going forward.
Yeah. Well, and it's interesting. So this will be a conversation for a different time, but Canada very resource rich, and so is the U.S. And we're entering this period of time where both self-sufficiency's got a higher priority on it for countries, but also there's a lot of countries that don't have abundant resources. Japan being a great example when it comes to energy. And the US-Canada powerhouse, if we are able to find ways to continue to work even more closely together, you can make an argument that there could be the dawn of a really new, exciting era for that partnership going forward. But let's save that for a different day. So to my my question that I sort of half-asked earlier. Um, I'm not saying this is going to happen, but assume for a moment that things do get worse from here. Um, uh, you know, or maybe I shouldn't even start with that, but like, given the current situation, what is your firm's general advice to the average investor? So what you're about to say isn't personal financial advice, and we all know that what matters is your own personal situation. So, folks take this with that disclaimer. But is this a time to start, uh, increasing cash reserves if you haven't started already? Is it time to be sort of positioning for the potential of a material correction, but then also if you've positioned well, then you have the dry powder to deploy when there's better valuations around?
Yeah, I'm reasonably comfortable with some of the weightings that we have, given what we're seeing right now, and that means we do have up to 25%, close to 25% that's in fixed income, very short term, short duration, investment savings type, money market type funds. So we do have liquidity, and that's larger in people who are closer to the wire or are retired, things like that. So we have higher, fixed income portfolios, allocations for them. For folks that are younger and continuing to add to their portfolios, I think as we tell them, this could be a wonderful time. I mean, we get volatility, you can dollar cost average, and you can invest more in the marketplace. So we've tried to position our clients, sanely, rationally long before something like this emerges. And sometimes we'll get the feedback from clients, hey, I want to be more invested in the market. I mean, can you increase my allocation? And that we say, just wait a second, just be patient. Because when things are going up, they all want to be 100% invested. When they're going down, they want to be zero invested in the equities, right? And so again, it's trying to find that balance and just hold people's hands, in a sense that you give them again a good rationale for their asset allocation. So we're pretty well positioned now. If things get really messy, we certainly go through and look at different clients that maybe we should have a little more cash, and depending on their aptitude and their risk tolerances. But most of our clients that don't want a lot of volatility, they're already positioned really safely and carefully before anything like this happens, because we know anything like this can happen at any time. Out of it can always come some exogenous event can hit the market. That's this of course has been a little more telegraphed, if you will, but sometimes you can have a real shock hit the system all of a sudden, and so investors have to be prepared beforehand. That's part of building a portfolio, part of I guess coming to an advisor and earning our keep, if you will.
Okay. All right. And then specifically when it comes to precious metals, they've had a lot of volatility right now. I want to ask you your thoughts on their direction, but I guess before I do, from a volatility standpoint, do you have any general advice for the precious metals investor? Is it a time to lighten up? I doubt that's going to be your answer, but is this a time to think about hedging? What are your general thoughts?
Yeah, I mean, a couple of things. Of course, it depends how you're positioned. If you were way overweight in the sector and it's way too much volatility for you, maybe you should trim back a little bit. I'm bullish long term, but I'm only saying that so that you can have a sane, and good night's sleep. So sometimes people just get overweighted, and I think sometimes it's better if they just take some off, even if they're going to, sell at a price where they might have a small loss at this point. But I mean, if they were investing in this sector, they probably still have fairly large gains if they were, in a disciplined way investing going over the last couple of years. So a couple of things. So nothing wrong with taking a little off if you're overweight and you're really nervous and you're, just can't sleep. I mean, people are, some people, they just can't handle the volatility. I think what we're trying to tell people though is that, look, if you have a reasonable weight in it, I mean, maybe it's 20% of your portfolio, and they're in great companies like Franco-Nevada or Wheat Precious Metals and some of the ones that we own, Agnico Eagle and things like that. Just stay tight. Don't be jumping around. These companies are trading at very attractive prices. If you look at the gold price right now, for say 4,600, and you look at sort of $70 silver, some of these companies like Agnico Eagle are trading at, an 8% free cash flow yield if that price holds up this for this year. And Franco-Nevada and Wheaton Precious Metals are trading at 5 and 6% free cash flow yield. So they're reasonably priced. And then what we try to get people to focus on is that we have an intractable debt problem. I mean, the global monetary system is under massive pressure. And so you want to make sure that you're keeping a certain percentage of your portfolio exposed to this area. And, just know the companies that you're in, make sure they're strong companies, make sure they're going to take advantage of volatility in the price also, and that they're continuing to grow their portfolios. When we look at the companies that we own, whether it's Agnico or Franco, Wheaton, and Cisco royalties, I mean, there's a number of them there. They have, in many cases, it varies, growth rates, but over the next few years, they're seeing 20, 30% growth in, in gold equivalent units and so forth. And so there's strong growth there, along with, I think, opportunity for price increase. So it's stay focused on the fundamentals, know what you own. If you bought something that's speculative that, is just gone up because everything went up, yeah, you're going to be nervous. If there's no foundation to what you own, there's no balance sheet, and there isn't resources being developed, then of course you should be nervous. But you probably shouldn't have bought that in the first place. So you want to be very careful and maybe lighten up on some of the junk and make sure you're in high quality.
Okay, well said. And also, there's a fair amount of talk about gold at the conference, no huge surprise. But several participants, especially Rick Rule, were saying that even at today's precious metals prices, right, which are off the highs, silver particularly so, um, even if they just stay here at the prices you mentioned, right, $4,500 gold and $70 silver, that in general, the miners are, in their opinion, underpriced given the jump in profits that these companies are going to see. A lot of these companies are still being valued as if gold is like 3,200 versus 4,500. And in particular, Rick was saying that the royalty sector, which doesn't have exposure to operating costs, right? So, the rise in oil, it doesn't impact the guys at the royalty companies. He said they look particularly underpriced right now. And he actually went through and shared a whole bunch of names that are on his radar list. So again, folks, if you want to find all that out, go buy the replay for the conference. But Jonathan, you're nodding as I'm saying all this, so it sounds like you feel similarly.
Yeah, no, absolutely. They're great businesses, and as you say, their costs don't go up. They're just going to get a percentage of the royalty, or they'll get a piece of the stream that comes off of them, as you know. And I think the other thing that Rick probably pointed out, which I think is 100% on track, is that again, this AI, digitization, all these long-term trends, they remain. I'm not saying that you should go out and buy NVIDIA. We don't own it, but I'm just saying that that those trends and need for power and energy and copper and so forth, those are going to continue to develop. And I think that a lot of these resource companies are going to look to some of these large royalty companies like Franco and Wheaton and Royal Gold to do more of their deals. We just saw this about a month ago with Wheaton Precious Metals providing $4 billion in capital, $4 billion royalty. I mean, it's just a massive royalty. And so I think there's more of these coming down the pipe, which will provide great opportunities for some of the larger royalty companies. It was thought for quite some time that they're out of deals. There's no deals to be done, but their cost of capital is so low and it's such an efficient model that they can come along and they're really the best providers of capital in many of these large projects, especially a lot of the copper projects. So I think there's a lot of different opportunities for them to grow, even if the price of gold and silver and copper just go sideways for a while. That's fine. Again, we get too caught up with people saying, silver is going to go to $500, it's going to go to $400, $500. You hear these different things. Maybe it does. I'm not attacking anybody that says that, but if they can make lots of money at 70 and you can do your models, if it goes to 500, hallelujah. But you can still make lots of money even at these current prices. And so when you look at silver, for example, again, the demand for that versus what's produced, there's a shortfall. There's been a shortfall for 5-6 years. It's needed. It's a strategic resource. It's becoming even more important in the future. So all of these things give me a good reason why I want to be in some great companies that can profit from it over time. And yeah, there's going to be price changes. There's going to be volatility. You have to stomach that if you're going to make a long-term return. But buy high quality, know what you buy, and buy them at attractive prices. And I think you can do exceptionally well over the next number of years because of, again, some of these long-term trends that I'm going to continue to bet on because I think they're just really large secular changes that are taking place in the world. If they don't take place, then that's a different story. But I think it's hard. Some of these trends are hard to reverse, and I think they're inexorable trends that are moving forward. Especially again, some of these the need for power and digitization, AI, robotics, all of these things are continuing to have a big influence on the materials market.
Okay. All right. Well, look, in starting to wrap up here, Jonathan, before we turn the camera on, we were talking about an issue that's sort of near and dear to your heart. And I will say elements have been woven into conversations I've had on this channel, over the past, I'd say probably a couple of years. I want to give you an opportunity to talk about it because I think it's particularly important right now. Well, and I'll explain why in just a moment, and I don't want to put words in your mouth, so you describe this any way you like, but it's important to you to kind of look at wealth building and the pursuit of a good life, we'll say, through a moral lens and not just a financial one. So elaborate on that.
Yeah, I mean, many years ago, I have a theology degree, so I do have a master's in theology actually. But I wrote a master's thesis on John Rawls' theory of justice. Actually, back in the he was a big shot at Harvard and wrote a big tome on justice. But what in going through that study and also studying theology, you realize that it's really the virtues and values of the culture which underpin everything else, the political system, the economic system, the cultural system, and so forth. It's really those values. And there was one book that I came across that was excellent. It's called The Economy in Mind. And it's written by Warren T. Brooks. It's a number of essays from Warren T. Brooks, who was an accomplished author and writer in newspapers through the 60s, 70s, and 80s, was quite instrumental, I think, in the Reagan administration. But he had a couple quotes in that book, which I think are really important for financial people to remember, because we get caught up in numbers and looking at resources. And sometimes we don't step back and say, well, really, what's the first order of importance when it comes to developing economy? So he has one quote I'll just read you, I think, which summarizes quite a bit of this. He says, "The primary and essential character of wealth is metaphysical, not physical, and is the direct result of the creativity of mind, not the availability of raw materials. The sum product of individual efforts, not the manipulated static resources of collective nations or governments or lands." And what he's really saying there, especially if you read the book in more detail, is that this whole issue of virtues and values and innovation and creativity, if you don't have that first and foremost, you're not going to develop the resources of your land. And we see that in country after country, countries with lots of natural resources. It doesn't mean they're rich if they don't develop it and they don't have innovation and creativity. One of the powerful forces in America, 250 years going from a very small, rather insignificant country to the world's dominant enterprise, has been the free market system and enterprise, innovation, creativity, virtue.
Right. The Industrial Revolution. Yeah.
Oh, yeah, absolutely. And he also has another comment. We often talk about money, and he says, "A dollar is not value, but representative of value, and at last, moral values." And he has a great section in the book, again, that shows you any culture that has a real lack of moral values and moral cohesion, lack of trust, lack of confidence in your institutions, all of these things, rule of law, and so forth, you'll find a dollar that is devaluing. It won't stand up. A country with a strong dollar, strong anchor in value over time will be one that is, again, infused with strong ethical and moral values. And I think this is really important for people to remember, that if we want to restore our currency value, we should look at the values of our civilization, our population, and say, hey, wait a second, where are we getting our value? And we kind of wonder, where are we going, and really what holds us together as a nation, as a people? What are the ethical values that we want to hold on to? Can we trust our neighbor? Can we actually enter into long-term contracts with confidence, and so forth? And so I think that that's something that, again, we as investment advisors and professionals need to go back and challenge the system. Where are our ethics? Where are morality, our morals? Are we anchoring them in the right place? And reestablish that. A secular or atheistic economy will not produce long-term wealth. And so we need to be innovative, creative. We need to think about our neighbor. We need to show love and compassion and entrepreneurship and think long term. Even as we go through some of these difficulties that we're experiencing now, we should always be thinking intergenerationally. What's going to be good for our kids and our grandkids? Not punishing our kids by overspending and running up our bills, but how can we actually create a better economy, a better world, a better culture for the next generation, and again for the one after that. So those are things that often we don't think about as much, but those are the things that ultimately are going to strengthen our economy and produce the wealth that we want to produce. If we just think of ourselves, then a selfish economy will ultimately go down, and we'll find our currency continuing to give up more and more value, which is what we're seeing with all of the printing of money and the debasement of currency, and not owning up to our own responsibilities now.
So I think this is a really important topic, and forgive me, I'm trying to pull up an image here. So let me see if I can do it in real time while we're talking. Yeah, there we go. So it's funny, I didn't know you had a theology degree, which explains why you're such a deep thinker and care so much about so many topics. It's sort of in my study of the world and all different types of thought paradigms and religions, et cetera. I do think there's this sort of common thread coming up, and you mentioned the word values several times. In my opinion, it doesn't really matter, which big deity in the sky, you believe is up there. It really comes down to the values that your belief system holds. And there was a great quote from Gandhi that I've repeated often on this channel, but I'll do it one more time. And that's what I'm pulling up here. It says, your beliefs become your thoughts become your words become your actions become your habits become your values become your destiny. And that last line of your values become your destiny, I think is exactly what you're saying, Jonathan. And it's funny because, we can see this play out in all eras of history, but we can even see it playing out in front of us right now. I just, in yesterday's weekly market recap video with Lance Roberts, I brought this up. You're seeing a tremendous amount of flight from New York State and New York City to other states right now, particularly Florida and Texas. And I put up some comparative data on the screen that just sort of compares New York versus Florida. And, on a lot of metrics, Florida just seems way more compelling. A lot of these are financial metrics. So, it's got, New York has some of the highest state income taxes in the country. Florida's got 0%. Cost of living index is substantially lower in Florida. Education cost is much lower, but performance is much higher. There's a whole bunch of things like that, right? And it's kind of like Gresham law, where bad money drives out good, right? If you have bad policies, eventually people will move to a place where the policies they think treat them better, right? And of course, the decisions we make, the policies we create, those are all determined by our values, right? Mm-hmm. And what I find really interesting about what's going on right now between those states in America is, you can look at it and say it's sort of a battle of the ideas between more free market capitalism versus more socialism and generous social programs, which New York is pushing more for. But you can also look at it as a really good current manifestation of federalism, which, as the founding fathers intended here in America, where they said, look, we're going to try to have a federal government that does the least. Now, of course, that has changed over time, but their vision was a federal government that kind of only did a few things, and then we'll let the states figure out really how to self-govern as much as possible, and we'll just have a whole bunch of running experiments. And at any given time, people can uproot themselves and go to a different state if that state they feel is treating them better. So again, I look at all this and just think it is the direct outcome of what you're talking about, right? If you have a set of values, one set of values, it's going to lead you to make a certain set of decisions. And over time, if somebody else has a different set of values that are leading to different decisions that the general populace says, I think that serves me better, we're seeing that it works. We're like literally seeing right now, pretty persistent outflows from one area and inflows into others for this reason of differences of values and differences of belief. So, of course, the other reason why I really liked why you brought this up was uh, I've talked about the importance of like knowing your why. Like at the end of the day, why are you doing all this, right? Why are you pursuing wealth? And why so many of the folks who watch this channel, you spend a lot of your time either creating the wealth, right? Slaving away at your job, or working to grow it through investing or things like that. It's something you think a lot about. You probably, spend an inordinate amount of your brain power thinking about how do I grow it or how do I not lose it. Why is it worth all that trouble, right? And it's not worth all that trouble just to have a whole bunch of dollars at the end of the day, right? It's because you want to be leaving a legacy of some sort in this world, right? You want to be providing for your immediate family. You want to be enriching life in the way that matters to you, spending time the way you want with the people that you want to spend it with, right? Those are all the things that are really important about, to really keep in the forefront of your mind, especially when the world gets kind of wonky like this, because there is no guarantee that you're going to come out through it okay. Now, this whole program is for us to talk about insights and strategies that will hopefully improve your odds of making it through it, as best you can financially. But as I like to remind people, look, there's no guarantees. The money can come, the money can go in life. You want to make sure that no matter what it does, you are still as rich as possible so that you've got this, the richest relationships in your life. You've got the most meaning in your life when you wake up in the morning. You've got good health no matter what the S&P does tomorrow, right? So it's keeping that why like really firmly in your crosshairs. You're nodding a lot as I'm saying this, so I'll hand the torch back to you. But that's a big thing when you were sort of talking about sort of the morality and the values that was coming to the forefront of my mind.
Yeah, I mean, what I would point out that you do want to make sure that you're rooting yourself in what is true. And of course, the big question is what is truth? And
Right.
that's we're going to have a big argument or a big discussion in terms of that. It's that vertical relationship that I think is important to have clear. And then once you have that vertical relationship right, then you can really have much healthier and stronger horizontal relationships. That then you know why you're here, what your purpose is. You've rooted yourself ultimately in eternity, and that's critical. Then it gives you a basis to interact on this world with each other and how we are to go about that. And so I think that the founders of the United States, they knew that they actually made it very clear that unless you had a virtuous and values oriented people, they wouldn't be worthy of the republic over time, right? You cannot run maximum freedom in a society without virtues and values and moral absolutes. And so these are things I think are really important. That freedom is not absolute. Freedom has to ultimately have a form. The issue is what form does it take? And so if you get into like you think of Florida and Florida and New York, I would argue that the economic policies being pursued by New York are a rejection of the created order. They stomp on the individuality of the importance of people, the value of people, and they take away initiative and creativity versus the policies of Florida are trying to reward people with maximum freedom to be able to operate as human beings. So, and then you'll see that one doesn't work and one does work. And that's the beauty of the system. I think it does correct itself. And so that's where if you spend money and you print money and you think that's going to produce wealth, doesn't work. Why doesn't it work? Because you have to work and you have to produce things if you're going to have any money to be able to transact in things. So that's what I like about ultimately the world of economics is you can only, try to get around reality for so long, and then it catches up with you because ultimately there are real values and there are moral absolutes that you have to abide by. And if you don't, payday will come. And I think that's what we're seeing a lot in the Western world, where we sort of jettisoned long-term discipline, frugality, investing for the long haul, family formation, children, another generation, investing, kids, grandkids, and so forth. But that comes at a massive cost to our society and to our culture. And I think that's what we're facing now. And we're seeing that now embedded in our politics and in our economics. And
Yeah.
we need to, again, think about these things, as you say, think about why we're here, what the purpose is, and make sure you've got a good reason. Otherwise, when things get tough, you can't take it otherwise. You're going to be strong and robust. You have to have a strong worldview that you can anchor yourself in. Yeah.
Yeah, very, very, and that word anchor, I think, is really important. So, great conversation here, Jonathan. My parting bits of advice to the audience here is, um, whatever your persuasion, whatever your particular, faith, lack of faith is, hopefully there's something in this conversation that's resonating with you, and recommend that you maybe spend some time, this weekend just reflecting on values. What are the values that you personally hold highest? And ask yourself, okay, am I living in accordance with them? And if I'm not, and none of us is perfect, where I'm out of alignment, what can I do to begin to bring my actions better into alignment with those values? And then similarly, ask yourself, those of you with families, what values do I want my family to embrace as well? And my guess is there would be your personal ones, but there might be some additional ones given the family structure. And then make sure that everybody in your family, is on board with those. And a lot of times we just sort of assume and all this stuff's unspoken, but sometimes it's actually good just to put it on the table and say, hey, as a family, I think this is what our key values are. Do we all agree? If we differ, why? Let's talk it through. But hopefully, try to get your family a little bit more mindful about following your lead as well.
Yeah, the family unit, the most important unit in society, Adam, and you'll find that nations that have strong families have small government. Nations with weak families have large government. The family unit is the strongest bulwark against totalitarianism, and so it is a major investment and incredibly important to invest in our families, our children, and the next generation. And there's nothing really more important in terms of driving an economy, a society, and a civil population that knows how to get along with one another. The family is the university of life. That's where you learn all of your basic principles, moralities, and ethics in the home. And so, yeah, your encouragement for people to invest in the family and think about that is 100% accurate.
All right, thanks. And look, if you're a younger person watching, obviously you're part of a family, have these conversations with your family, but I also would say look to people around you who are older, who you think are really doing it well, and ask them, what are your values, and find out what they have in common, and if that's something that wasn't already on your list, consider adding it there. All right. I didn't expect us to get so metaphysical, but it was really fun to do that today, and I think it was very worthwhile, especially in such a chaotic time. Thanks so much, Jonathan. So folks, first off, please thank Jonathan for giving us such a great conversation today by hitting the like button and then clicking on the subscribe button, as well as that little bell icon right next to it. As a reminder, Jonathan is Thoughtful Money's he's the head of Thoughtful Money's endorsed financial advisor up in Canada, Rocklinc Investment Partners. If you would like to schedule, if you're Canadian and would like to schedule a consultation with them, you can do so, and I'll tell you in just a second. But also, if you're in the US and you'd like to talk to one of our US advisors as well, this guidance will apply to you as well. Just go fill out the very short form at thoughtfulmoney.com. It'll only take you a couple of seconds. And once you do, the firm that you get matched with will reach out to you right away, and you can have one of the free consultations that they offer. As a reminder, these consultations are totally free. There's no commitments involved. It's just a service these firms offer to be as helpful to as many people as possible. And if you are a Canadian, don't forget when you're filling out the form where it says country of residence, click Canada. And if you do, you'll be connected with Jonathan and his team there. Lastly, too, if you missed the conference that we just had yesterday, but would like to watch the replay of it, just go purchase the replay over at thoughtfulmoney.com/conference. Thanks so much, Jonathan. Great to catch up with you. I'll let you have the last word here.
No, thank you very much, Adam. It's always wonderful to speak with you. Thank you for the work that you do, and the wonderful speakers they have on. As I told you before, I listen to probably 60–70% of the sessions, and find them incredibly valuable, and integrate many of the ideas into our own business and practice. So keep it going. The specialists that you have are fantastic, and it really helps.
All right, thank you. And for the folks who are saying he only listens to 60–70%, it is an 11-hour event, folks. So that's 6 to 7 hours he's giving up on his Saturday. So he's still making a big contribution there. All right, Jonathan, thanks so much.
I'm talking about your ongoing programs all the time. I'm listening to your day after day after day.
Oh my goodness.
And enjoy them. And you have tremendous speakers. And so I really appreciate it. I'll listen to all of the speakers eventually on the replays that you're going to have on the conference.
Wow. Well, thank you so much. And look, I know what a busy life you lead, and the fact that you listen to that many on a regular, ongoing basis is a huge honor. So thanks so much, Jonathan. All right, great conversation. And Jonathan, I'll see you again soon. And everybody else, thanks so much for watching.
Gold is becoming more expensive. It is the dollar which is losing its purchasing power versus gold. The price has been steadily moving upward over the last 2 years. And it surges it breaks out, it surges 15%, it consolidates for another 3-4 months, breaks out, surges 15, 20%, consolidates for 3 or 4 months. This has happened 3 or 4 times now. And as most people know, it's been consolidated under 3,500 since about April or May. It's now broken out, and I think there's a rush of speculative interest because another 15%, if we keep the pattern going, takes us up to about $4,000 an ounce. I think the next move in this current move is probably to 43.5, 44. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through.
Gold's rise isn't about it becoming more expensive. It's the dollar steadily losing value against it. For the past 2 years, gold has followed a pattern of breaking out, surging 15 to 20%, then consolidating for a few months before repeating the cycle. After holding under $3,500 since spring, it has now broken higher, and if the trend continues, the next leg could carry it toward $4,000 an ounce. Silver, meanwhile, looks set for a move toward $43 to $44 in the near term, and with expected rate cuts and yield curve control ahead, next year could be when it finally breaks through the long-standing $50 barrier. Craig Hemke is a longtime precious metals analyst and founder of the website TF Metals Report. He recalls that back in 2011, silver's sharp run from $38 to $48 in just 4 weeks wasn't a bubble, but the result of a commercial short squeeze. Speculators were long while commercials were heavily short, and when shorts had to cover, prices exploded. If commercials pile on new shorts, silver will likely grind higher in a slow, stair-step move. But if they start covering without heavy speculative buying yet, that could trigger a breakout, drawing in new money and creating a powerful rally. Silver tends to sit quietly for long stretches, but once momentum builds, FOMO quickly takes hold. The current move may aim for $43 to $44 before pulling back, but next year, with rate cuts and yield curve control likely, it could be the time silver finally smashes through $50. If it does, tests that level as support, and holds above it, then the market could truly take off. If silver breaks above $50, the real stress will likely show in London's physical market, not comics. With supply deficits, limited float, and heavy reliance on paper ETF instead of real bullion, a surge in demand could expose shortages and trigger major volatility. That's when silver could truly get spicy. As we play Craig Hemke's video, kindly click the like button, subscribe to our channel, and enable the notification bell to receive fast alerts whenever we post a new video. I appreciate your support. Have fun watching the video.
Crazy breakout camp just yet. I think it's an important time for people to be paying attention to what's going on internally with silver. In April of 2011, okay, so most people remember that, price went from 38 to 48 in about 4 weeks of that month, over the course of the month. And it was assumed, it was written up, and people look back, with revisionist history and make it sound like it was a big speculative bubble. What was actually going on, if you followed the Commitment of Traders report back then, was a commercial short squeeze. They had all these speculators that are long, all these commercials that are short, and they started having to cover shorts for, without going into all the details as to who was short and why and all that stuff. But you could just see it on the Commitment of Traders reports. And that's what took it from 38 to 48. I think, could we have a similar month now? Of course. But we want to be watching those Commitment of Traders reports because it'll tell you a lot. If the commercial side of that equation is aggressively adding new shorts this month, okay, well, we're just in that kind of stair step phase, of 2 steps forward and 1 step back. But if we start seeing a lot of commercial short covering without a lot of new speculative money yet, and that's what drives us, well, then when we get that breakout of top of the cup, then you get this big rush of speculative money that just catapults you further. Because silver's a lot like, and I'm sure I've used this metaphor before. It's like Newton's law of inertia or motion or whatever it is. I took physics, but it was a long time ago. An object at rest remains at rest until a force is applied to it, right? Just sit there. My computer's right here, but if I push it, okay, all right, it'll remain at rest until a force. And that's kind of what silver's like. Silver just sit there, as we all know, and just do jack for a long period of time, even like not keeping up with gold because people are waiting. They're like, well, I'm not going to get involved in silver yet because it's just sitting there doing nothing. But then as it starts to get moving, then you get this kind of FOMO thing. Hey, we've seen this before. And so what will probably happen, I would not expect it to smash through the $48 to $50 all-time highs in the first try. That's generally not how it works. And so I wouldn't think we would get there this year. You go up, we could go to, I think the next move is, in this current move, is probably to 43 and a half, 44, given the channel that we've been tracking higher. Pull back, maybe under certain conditions, we make another run later this year. I think it's in next year. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through. You go up, tap it, find resistance, finally break through, everybody goes crazy, and then it pulls back, tests that old resistance level for support. And if it finds the support and you stay above 50 and then start making new highs after that, well then, holy Toledo, then we could have some fun. And this all the stuff we've talked about all these years, Elijah, about how much silver is there really in the world? The supply deficit over the last 4 years. How much free float is there in London? How many ounces are levered, how many times, supporting the derivative markets, all that stuff. If we set off on this, breakthrough 50 and everybody starts getting excited and the banks don't want to fool around with it anymore because they don't have it, they don't want to deliver theirs out or whatever, things could really get spicy next year. I saw that stuff too last week. There were 9,000, I can't remember, 9,900 or something COMEX September silver contracts that were open and standing for delivery when that contract went off the board. And then it gets delivered against, you got to be 100% margin long covered so that you can take delivery if that you're long and somebody the short puts the silver to you. And historically that's a lot. But back in March and May, we were doing 18,000 contracts. Okay, so it's not like, oh, wow, it's 10,000 in September, the system. No, it's not. No, not yet, at least. Okay, but it is a not insignificant amount. If we've already delivered almost all of those, that's 50 million ounces. I don't know if it ever actually leaves the COMEX or if it's still just this, oh, this month I'll take delivery, next month you take delivery stuff. So we'll keep an eye on that. I don't think that's where the stress is. To me, after kind of getting excited about that 15 years ago, I don't think that it's the COMEX where you'll see delivery stress. It's more likely in London. I'll give you this. I mean, you've seen over the years, Elijah, and I'm sure everybody listening has seen this, we're like Stan Druckenmiller or Ray Dalio or, whomever, some big hedge fund manager, they'll say, we want to own gold. And you're like, good. And then they buy the GLD, right? And you're like, well, what good is that? I mean, that gives you price exposure, but you don't really, you can't take delivery, Stan. You can't take delivery.
Craig Hemke explains that the dollar index is misleading, as it only compares the dollar to other weakening fiat currencies. While it appears stable, all major currencies are losing purchasing power together. Recently, talk of yield curve control has quickly gone mainstream, signaling that central banks may soon cap long-term rates to contain debt costs. The U.S. looks set to follow this path, echoing past strategies to manage high debt. If that happens, it would echo what the U.S. did after World War II, when debt to GDP ratios were similar. Back then, the Fed and Treasury worked together to hold rates down, effectively inflating away the debt with cheaper dollars in the future. We could see something similar soon, especially if Fed leadership changes. This would likely require massive new quantitative easing, with central banks buying and monetizing their own debt in a move resembling modern monetary theory. Such a shift would push real interest rates deep into negative territory, and that's extraordinarily bullish for gold and other precious metals as fiat currencies are steadily devalued.
The deception of the dollar index, because it just compares the US dollar versus all this other equally worthless fiat, right? And so the dollar over time, you pull up a 30-year price chart of the dollar index, and it's, it's 100 and it goes up to 120 and down to 80, and it just stays basically the same. Well, that's because all the other fiat currencies are devaluing at the same rate. But I said, expect more rate cuts than what people are thinking are coming. And furthermore, don't be surprised if by December, the December FOMC meeting, the Fed isn't openly talking about yield curve control. And I mean, I wrote that like on New Year's Eve last year. There were nobody talking about yield curve control. But now, all of a sudden, here in late August, early September, it's like, oh yeah, yield curve control is coming, like everybody was predicting this 8 months ago. Yield curve control is coming. Whether it's globally, if all these central banks have to do that to control the long end of their curve, right, and control their interest costs. But I think you're definitely being told and warned that it's coming here in the U.S. And I think that's all part of what's driving gold too, because that would be extremely bullish news for gold. You'd be holding real interest rates sharply negative. I mean, the U.S. has done this before, which is why I wrote about it in my pod. I even put a link in there in that macrocast, because coming out of World War II, when we had similar debt to GDP ratios, that's what they did. They kind of combined the Fed and the Treasury together. They did yield curve control, essentially to pay off the debts of yesterday with the cheaper money of tomorrow, right? Get it under control, grow your way out of it, which is what Besant keeps talking about now. Well, anyway, if you want to take the time, to connect the dots, I think they're telling you that's what's coming as soon as next year, once Powell gets replaced and everything else. And so if that's the case, they're going to be trying to cap the long end. It's going to involve a lot of new quantitative easing measures, central banks buying their own debt, monetizing, almost like a modern monetary theory move. Again, all of this is extraordinarily bullish for the precious metals in terms of devaluing the existing fiat currency.
Both gold and silver are flashing signals of major shifts ahead, fueled by monetary policy, debt dynamics, and the growing disconnect between paper markets and physical supply. If central banks resort to yield curve control and deeper monetary easing, precious metals could enter a new era of explosive gains, marking a turning point for investors who have been patiently watching these markets build momentum. Do you think central banks will be forced into yield curve control sooner rather than later? If silver finally breaks above $50, will physical shortages in London expose the true limits of supply? Leave a comment below with your opinions. We would be delighted to hear from you. Please remember to subscribe for more material, and give this video a thumbs up if you found it useful. We appreciate you joining us on this adventure.
Gold's up, almost 40%,
Yeah.
but gold stocks have more than doubled. So, and so people have made a lot more money, starting in April, because even the first quarter, the gold stocks didn't even move. It started in Q2, but I don't even think gold stocks have caught up to $3,000 gold yet, let alone 3,700. And we could easily be at 4,000 by the end of the year. We're going to get into a stage, maybe next year, with gold well north of 4,000, maybe 5,000. Maybe the gold stocks double again from here. But at some point, they're going to get on the radar of the average portfolio manager, and they're going to start buying. If silver hits 50 when gold's at 4,000, and I think that once silver gets above 50, I think it's going to take off. I think the move from 50 to 100 will be relatively quick.
Gold has climbed nearly 40%, but gold mining stocks have more than doubled since April. The bank raised its 2026 gold price forecast from $3,700 to $4,000, citing strong central bank demand, possible U.S. dollar weakness, and expectations that the Federal Reserve will ease rates. If gold pushes above $4,000 or even $5,000 next year, miners could double again, eventually attracting big institutional investors. On the silver side, once it breaks $50, in the near to medium term, especially if industrial demand and investment flows remain strong, the run to $100 could happen much faster. Peter Schiff is a well-known economist, investor, and outspoken critic of U.S. monetary policy. He recalls that earlier this year, gold mining stocks were so undervalued compared to gold itself that they offered far better upside with minimal downside risk. Goldman Sachs sees gold $4,000 if investors shift more into metal. Their baseline is $3,700 in 2025, $4,000 mid-2026. If there's a big dollar asset exit, gold might go toward $5,000. Jeffries says gold mining stocks have underperformed despite gold's big gains. Many miner valuations still reflect much lower presumed gold prices. Newmont has already doubled this year but still seen as undervalued compared to what gold's price implies. Free cash flow growth, share buybacks, etc., are driving analyst upgrades. Peter believes central banks continue buying aggressively to shed dollars, making gold an increasingly vital reserve asset. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
$3,000 an ounce for gold when I can buy gold in the ground that's still valued at less than $2,000. In fact, way less than that. I thought that if you looked at what you were paying to buy these gold mining companies, that gold still in the ground had never been so cheap relative to gold above ground. So it wasn't that I didn't think gold was going to keep going up. Mm-hmm. I just thought, why buy it when they're giving away these gold mining stocks and they're so cheap, and the downside I thought was so minimal. It made a lot of sense. And, now I think year to date, gold's up, almost 40%, but gold stocks have more than doubled. So, and so people have made a lot more money, starting in April, because even the first quarter, the gold stocks didn't even move. It started in Q2, and the whole doubling was basically in the last maybe 6 months. Didn't even take a whole year to double. And so, but I don't even think gold stocks have caught up to $3,000 gold yet, let alone 3,700. And we could easily be at 4,000 by the end of the year. So, I'm not telling people to stop buying physical gold and silver now because it's not that obvious, but at that moment in time, to me, these mining stocks were so ridiculously cheap that I couldn't see putting any money into physical gold when you could just buy these miners. I just did not see the downside risk, and I thought there was huge upside potential. Now we've realized some of that upside potential, but I think in the scheme of things, these stocks are still very cheap. If you look at the PEs of the big gold companies, they're very low compared to historic averages, compared to the market multiples. The investors are not in. I mean, they've still had net liquidations all year out of GDX and GDXJ, these gold mining ETFs. Nobody talks about these stocks. Nobody owns these stocks. Yeah. Newmont Mining is the best performing stock in the S&P 500, yet it's probably the stock that's least owned in the S&P 500. They're going to make nothing but money for years to come. They are producing a product that everybody needs, whether they realize it or not. I mean, the central banks are huge committed buyers, right? They're not going to stop buying gold because they're not going to stop divesting of dollars. And they keep earning dollars, right? Because we're hemorrhaging dollars due to our trade deficit. So not only do they have to get rid of the dollars they own, they have to get rid of the dollars that they keep getting. And so they're going to keep buying gold. And as the price of gold rises, it's just going to suck more central banks into it, because the central banks that aren't buying gold are falling behind the ones that are. And gold is becoming increasingly more important as a reserve asset, not just because central banks are buying more of it, but because the price of what they own keeps going up. And that means that the value of their gold as a percentage of total reserves keeps going up. And so, there's going to be a FOMO in central banks to get into gold. And they're just, they're price agnostic. I mean, they're not going to stop buying because the price goes up, because they're just trying to get rid of their dollars before the price goes down. But at some point, the investing public is going to join this party. I mean, I think to an extent, some money is already coming in, and that's why the gold stocks have had the move that they had. But this is just the tip of a huge iceberg that we've seen. And so far, the buyers have been patient, and they've been buying on the pullbacks, and there hasn't been any crazy up days. There's no real euphoria, and I still see sharp corrections like what we're having today. Gold doesn't even go down, right? Yeah. And all of a sudden these stocks are down 3 or 4% just because people are afraid. Oh no, this is it. But the minute gold doesn't go down and goes back up, then the buyers come rushing in. The coast is clear. But we're going to get into a stage maybe next year, with gold well north of 4,000, maybe 5,000. Maybe the gold stocks double again from here. But at some point, they're going to get on the radar of the average portfolio manager, and they're going to start buying.
Peter highlights that smaller gold companies with proven reserves but no production yet offer strong value, as larger producers flush with cash may buy them out rather than fund risky exploration. Gold is up 30 to 40% year to date, with miners outperforming but still undervalued, leaving room for further gains, M&A, and institutional inflows if prices hit $4,000 to $5,000. Central banks remain steady buyers, reinforcing long-term demand. Juniors with proven reserves but no output look attractive as takeover targets for cash-rich majors. Silver faces structural deficits from industrial use and ETFs, making it highly sensitive to new demand. $44 to $50 is the next target, with a possible rapid surge to $100 in a blow-off rally. Peter predicts if silver breaks above $50 while gold hits $4,000, it could quickly surge toward $100, unleashing pent-up demand, since silver is still below its 1980 high while gold has far surpassed its own. Let's review the interview.
There's a lot of smaller companies that aren't as speculative as you think. I mean, if you're talking about a pure exploration type company, because you don't know what they're going to find. Maybe they find nothing. But there are a lot of very small companies that have proven reserves that they just haven't raised the capital to dig up yet, right? They're at the earlier stage. You're not at the exploration stage, although they may be exploring for more, but they have provable assets, and they just haven't developed them. So they're not, in production. They're not generating any income. And I think there's some incredible value there, because I think these companies are going to get bought up. I mean, it'll be a much friendlier environment to raise capital in the future, and they will be able to raise capital to build out these projects. But I don't think they'll have to, because I think the bigger companies that really have not been investing much in exploration and development, they've just been paying down debt, and now they're buying back stock. I think they're just going to have so much cash that they're generating, they're going to have to do stuff with it. And I think it's going to be cheaper to buy out other companies than spend money on exploration and development. I mean, because you roll the dice on exploration, you don't even know what you're going to find.
True.
Why do that when you could just buy up these companies and get their whole book of business, right, on the cheap? So I look, there's just going to be so much money made, I think, in the consolidation of this industry, which I think is going to happen before there's any really major increase in exploration and, of new projects, which is another reason, the price is going to keep going up.
Yeah.
Because there's not going to be, it's not like when gold is $5,000 an ounce, there's suddenly going to be all this extra gold that's being mined. It's not going to be there. Yeah, there may be some more marginal supply. Maybe Americans will start selling off their jewelry at $5,000 gold, to pay the grocery bill, but that's not going to make much of a difference in the scheme of things. And so there's not going to be a lot of new production. Yeah. And, one of the sources of supply used to be central banks selling. Mm-hmm. Central banks are not selling. Again, they're buying, and they're going to keep buying, especially these emerging market BRIC nations. They still have, very small percentages of total reserves in gold, even though they've been buying. They have a lot more to buy. Yeah. It's just that the major central banks, like, in Western Europe, United States, where we still have a lot of gold, but we haven't been buying, right? The United States hasn't bought any gold. No. I mean, we're thinking about buying Bitcoin. That's how dumb we are. There isn't a lot of silver out there relative to the demand that I see for it in industry, but silver is just cheap, and it's cheap relative to gold, and that's the best barometer of whether something is cheap or not, is look at it priced in gold. And you can still get a lot of silver for an ounce of gold. And, even at $50 silver and $4,000 gold, that's still 80 to 1. Yeah. That's still pretty cheap. Yeah. If silver hits 50 when gold's at 4,000. And I think that once silver gets above 50, I think it's going to take off. I think the move from 50 to 100 will be relatively quick. I mean, it'll be a lot quicker than the move from 30 to 50. It may even be quicker than the move from 40 to 50. But I think it's going to unleash a lot of pent-up demand. I mean, why shouldn't silver be double its 2000 or 1980 high? I mean, gold's 1980 high was 850. And we're quadruple that. So, I mean, and silver is still below its 1980 high. And so, there's not that many things that you could find that are cheaper than they were in 1980. Silver's one of them. I think it's very cheap. And other precious metals are cheap too. Look at platinum. I mean, compared to the price of gold, and platinum has already had a big move this year, but it's still pretty cheap. So I think we're finally starting to see some of the other precious metals moving, but silver has always had a stronger monetary correlation with.
Would central bank purchases result in a permanent floor on the price of gold and silver? Before the next step higher, will institutional investors finally see the benefits of mining stocks? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
We're moving into a new digital system. I believe that this will now usher in the hyperinflation to burn off the debt that's being created. So we'll have Amazon stablecoins and Walmart stablecoins and Kmart stablecoins and, JC Penney, as well as JP Morgan, as well as Hong Kong stable coins, the yuan stable coins. So it is an extraordinarily fragmented market, but they are thinking that within the next 2.5 years, by 2028, they will go from about 125 billion stable coins to $2 trillion in stable coins.
Stablecoin adoption is accelerating, with issuance doubling to $250 billion from $120 billion. Offering a more tempered outlook, JP Morgan estimates the market may reach $500 billion by 2028. Meanwhile, forecasts suggest the market could grow to $400 billion by year-end and $2 trillion by 2028, citing limited mainstream adoption and regulatory challenges. Yet, only 6% of usage is tied to real-world payments, while most remains in trading and DeFi. The Genius Act is shaping regulatory clarity, boosting institutional interest as major players like JP Morgan, Amazon, and Walmart explore stablecoin models. Analysts see them becoming core payment infrastructure, bridging fiat and digital money in a hybrid financial system. The speaker, Lynette, the chief market analyst at IDM Trading, argues that silver and gold are massively undervalued compared to their true historical ratios and fundamental worth. Based on a traditional 20-to-1 gold to silver ratio, silver could be valued between $1,300 and $2,000 per ounce, while gold's fair value could range from $33,000 to $40,000. Current spot prices are seen as artificially suppressed by paper derivatives, but since both metals are sound money, they cannot be inflated away like fiat currencies. In times of crisis, gold and silver act as a bridge, preserving purchasing power as overvalued fiat-based assets, and real estate collapse, enabling wealth transfer to those holding real money. Looking ahead, Lynette warns of inevitable hyperinflation as currencies lose credibility. In such scenarios, governments historically revalue gold to restore public trust, often after lopping zeros off collapsing currencies. While gold and silver prices would soar during hyperinflation, gold has historically held elevated value longer than other assets before being adjusted, only to climb again under the new system. This pattern, repeated throughout history, is expected to play out again. As we present clips from the video, firstly, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
What happened in 1980 at that $50 mark, I consider this a massive double cup because it did come up to breach that level. And so when it goes above that 50, would 3 or even 4 digits in the silver nominal price, the price that we see, would that be outrageous? No, it's worth at a minimum $1,300 an ounce, and that's just based on the 20th to 1 that historically we were. These were both, well, it's peace dollar. Okay. These are both $1, little $1 gold coin and a silver dollar. So that's a 20-to-1 ratio right there. So according to my calculations, you're looking at the true fundamental value of an ounce of gold at somewhere between $33,000 and $40,000 an ounce. So at $3,400, spot gold is a ridiculous bargain. But that also then means that silver's fundamental value at this moment is somewhere between $1,300 and $2,000. And remember, the more of this that they do, the higher those numbers go, because this is fiat money, government debt-based money. But gold and silver are sound money. Sound money is money that governments and central banks cannot inflate away. They can manipulate what you see through the use of garbage derivatives, but they cannot inflate it away. The point is they are both money. They're just the opposite sides of that money coin. And as this loses more and more and more of its purchasing power value, these go up in nominal terms. But what they really do is they create a bridge, because when one currency goes away, another one comes in. It's just that you need something and I need something. We need something that will hold its purchasing power intact to get us from one system into the next system. And dare I say it, even have the ability to take advantage of the opportunities that will present as these extremely severely overvalued fiat money assets. And real estate is actually not pure fiat money, because it is a tangible as well, but it's severely overvalued. That's going to flip-flop. So if you can hold your purchasing power intact, you're going to be able to have that wealth transfer your way. Well, I personally do not see it I see it as inevitable, because what gold really does is it regains confidence. I mean, they want us to think that gold is an old relic, except wedding rings are generally in gold. Good as gold. It's in our vernacular. It's in our DNA, and it's used to regain public confidence after that massive failure, which I believe we are like this close to experiencing, and the hyperinflation. But make no mistake, every single country has a gold revaluation account. They're not going to do it at these levels because it does not reflect all the paper money that's been issued. So what I think we will see, and it's just a repetition of history, because this has happened over 4,800 times. I don't think this time is any different, and that's really what the point is. But they have to, you have to kind of back up to move forward. If they did it now at the artificial level that the spot markets are, then it wouldn't have as great an impact if they wait until they finish blowing up the currency in a bout of massive hyperinflation. And what they do then is, of course, they lop off zeros so people think, well, they've got this under control. So you've got a loaf of bread. And I know this sounds outrageous, but it's not outrageous. It is just a repetition of history, where a loaf of bread might go for, as it enters hyperinflation, a loaf of bread might go for $80,000 a loaf, right? But then what happens? They lop off 3 zeros or 4 zeros as they do that overnight revaluation. And so it goes from $80,000 a loaf to $8 a loaf. But so do your savings, and so do anything that you've accumulated in fiat. And frankly, so will the nominal price of gold. First, it'll go up massively, right, in the hyperinflation. But the difference between, say, your stocks and everything else, that drops dramatically immediately upon the revaluation. Whereas gold, it's on average, so I can't guarantee this, but on average will stay up at that level for about 9 months before it too gets revalued, but then it instantly begins to climb again in terms of that new currency. So that is what I anticipate seeing. I don't anticipate seeing it before we do hyperinflation, because there is not yet the need to regain that public confidence. But I watch that like a hawk, because that, my friend, is the only thing that's keeping all of this stuff together.
The $50 silver level from 1980 remains important because it highlights how heavily manipulated these markets are. Just as gold and silver were once taken from the public and openly admitted to be manipulated by governments, today's spot prices don't reflect true price discovery, with LBMA inventories dropping sharply before partially recovering, while silver holdings remain much lower. This underscores silver's dual role as both an industrial and monetary metal, making it more vulnerable to hidden maneuvers. ETFs like SLV also expose this manipulation. Their structure was altered so they no longer need to back shares with actual silver. That leaves ordinary investors holding paper claims, while powerful players like JP Morgan or Saudi Arabia could still take delivery of the physical metal. This setup creates a backdoor way for institutions to control silver supplies, while the risks and losses are pushed onto the public, who falsely believe they own real silver through these trusts. Let's shift our attention towards the interview.
Yes, I definitely do think that triple digit price. Now, one thing that you mentioned about 80s with the Hunt brothers accumulating silver, because they wanted to leave the US and form their own little country in Texas. However, the importance of that should not be just trivialized or ignored, because what we were really dealing with was an overt manipulation by our government of the silver markets. And everybody was warned. And I have to say, Jesse, I have often wondered when these things that happened, and they seem outrageous to me, like taking the gold away from the population, like taking the silver away from the population, like a sitting president admitting that they're going to manipulate the markets. And I used to wonder how they could get away with that, why people didn't rise up and say, no, you can't do that. That's crazy. Well, I think we're living through that right now. And I'm seeing it happen. I think there's a lot of blindness that's going on. So I do actually consider the $50 mark nominal, to your point, to a very valid point, because these markets are manipulated. They are admittedly manipulated. And so if anybody really expects there to be any level of good price discovery with spot gold or spot silver, and I always make sure I say spot because that is just a contract. And when you're talking about silver, there's a chart from the LBMA that they came up, and of course we know that there was a huge rush of physical coming into America at the beginning of this year. And you can see the stores in the LBMA dropping in gold, dropping and then rising again and coming back pretty close to the levels that they had before whatever came out of the LBMA. I'm actually more interested in what came out of the BOE, but let's just stay with the LBMA for a minute, because the same kind of issue with the physical metal being shipped over happened with silver as well, but their stores are significantly lower than they were before that physical push into the US. So what does that tell you? It tells you that silver gets used up in industry. And just like the SLV silver ETF that is supposed to be a basket of silver, they couldn't put the basket together. So back in, I don't remember whether it was 21 or 20, but they changed the prospectus. SLV changed its prospectus so that they didn't actually have to pull a basket of silver in, but rather all they had to do, which is what they were designed to do anyway, which is imitate the spot silver market. I think we could see that because silver is the secondary monetary metal, but it is rather, I'm pretty sure that Saudi Arabia would be considered an administrator, which means that they would, you and I can't do it, but they would have the ability to take possession of the underlying silver. So I think that that is a manipulation to make that happen, because that can happen even more invisibly than what we were just talking about. And since silver is used across every single sector of the global economy, in solar, in medicine, et cetera, and gold is as well. Both of them are, but silver more so straddles that world. I think that this could also be a maneuver to ensure that they get their hands on the physical silver. At the end of the day, the holders of SLV won't. I mean, the normal holders of SLV wouldn't, but JP Morgan would and Saudi Arabia would. So I think it's a backdoor way to do it and have control of it. But the real problem is it would have to be done strategically. Like I'd be curious to see how much of a percentage of the holdings that they already have in silver that would actually represent. Because if they did take out the physical at the same time that SLV itself, that trust, is selling off bits of silver on a daily basis to pay the rest of the fees, the repercussions for the public would be huge. Those that think that they actually own silver with an SLV, they just own shares in a trust. But that could have some really significant significant impact on the risk transfer to the public.
The rise of digital currencies, the undervaluation of gold and silver, and the ongoing manipulation of precious metal markets all point to a fragile and shifting financial system. As fiat currencies weaken and hyperinflation risks grow, physical gold and silver remain the most reliable anchors of purchasing power, offering protection and opportunity during systemic transition. The real question is not if, but when this reset will force the world to rediscover the value of sound money. Do you think central banks will allow the public to benefit from gold and silver's true revaluation? How should ordinary investors prepare for a financial reset driven by digital money and precious metals? Please share your thoughts in the space provided for comments below. Please remember to subscribe to stay updated and to give this material a thumbs up if you found it helpful. We appreciate you coming along on the ride.